This is Barry Knapp with Ironsides Macroeconomics. It's Sunday, January 2nd. It's been 2 weeks since we've released a audio summary of our notes, though we did write brief notes each of the last 2 weeks. We wrote about a strong finish to 2021 2 weeks ago, and then this week we wrote a note titled Just in Case about inventory supply chain management. There's been a couple of themes worth noting that we'll walk through in our market and macro recap of the last couple of weeks. We wrote this week a section called Inflation and Earnings. It was a little bit of an earnings preview, but it was really about the dynamics of the corporate sector and how it's dealing with inflation. There's been lots of calls that earnings growth is going to slow decidedly and that rising inflation is going to put pressure on margins. We don't agree with that general point of view. And then this week, we wrote a little bit of a macro preview for the upcoming week, which should be quite interesting between getting some additional clarity on Fed policy as well as the monthly labor market data. So first of all, we hope you all had a good holiday. We had a fantastic time out here in Vail. We had 4 feet of snow over the last 9 days or so, and managed to go skiing 8 days in a row. Not the full day, because I did pay some attention to markets, but did get 8 days in a row of skiing in, and we have more snow on the way. We've gone from having a subpar year to a above average year now. We'll see how it progresses from this point. So back to the markets, away from the ski report. The market, we felt 2 weeks ago when we wrote the market was going to finish strong for 3 real main reasons. One was the growing evidence that the Omicron variant is likely to bridge from pandemic to endemic. We released or included a study out of South Africa that determined that Omicron will offer immunity against Delta. It will, and likely future variants as well, and that there's been a growing body of evidence that the infections primarily impact your nasal system and upper, as opposed to your lungs, your upper respiratory system. And so it does look like it's far less serious, although obviously we have more infections, at least measured infections, than we've had. But we thought that that was on balance probably a net positive. The collapse of the Build Back Better plan, which at least initially got a bit of a negative reaction from the markets, we thought was an unmitigated positive for equity investors. It sets the stage for much stronger earnings growth. Obviously, we're not going to, if it is indeed dead, we won't have these international provisions that'll impact earnings for big multinational corporations. And it's a big positive for capital investment, which is the theme we're going to talk about additionally in the next couple of minutes. So the collapse of Build Back Better was an unmitigated positive for equity investors. Taking money out of the corporate sector to pay for social spending by no means can be viewed as a positive for investors. So enough on that. And then the third theme was, as monetary policy begins to normalize in the beginning of the year, although we've written a lot about this, we talked about it, we do think at times the market's going to be concerned. We think we're likely to have a pattern through the first half of the year where when we're in the lead up to earnings, when we get earnings season, the market will react favorably to that. But when we're in periods where we're right around Fed meetings and all, the markets will worry about the impact of tighter monetary policy. But quite frankly, in our view, monetary policy is so easy that it's counterproductive at this point. So on balance, the removal of that ultra-accommodation will help bank sector profitability. We would note that in the latest existing home sales report for the month of November, first-time buyers have gone from 33% of total buyers a year ago to 26% now. This is financial buyers crowding out first-time millennials forming households. This is a net negative. Financial buyers buying houses are fine, but it would be much better if millennials were forming households, furnishing those homes, and getting into their lifestyle consumption patterns. So this on balance at least in the early stages, we think normalizing monetary policy is a net economic positive, not a negative, though, again, markets will struggle with it at times. So those three themes we thought would carry the market through the end of the year. And now that we're into the beginning of the next year, we're going to have to really start to deal with it. And we talked about earnings season in this week's note. We walked through just how strong operating leverage is for the corporate sector. You can see earnings growth has far exceeded revenue growth, which has picked up as well. So you've got these very fat profit margins, strong cash flow, all of which provides the means for a very robust CapEx cycle. And the mix of growth matters a lot. This is a constant theme in our writing about how some people will talk about the nature of consumption. They think goods consumption is better for corporate profitability than services consumption. We'll grant that, but more importantly, we think I is better than C. Investment is better than consumption. And we would note that having received the latest round of December regional Fed surveys, CapEx plans remain incredibly robust. And the latest reading we got for bottoms-up CapEx for the month of December was quite strong. You've had a big step up there. And as earnings season comes through, we think we're going to hear a lot more from the corporate sector about CapEx. And we think investors are going to reward companies for investing in CapEx. So that was a big theme. And again, back to this inflation dynamic, because of that operating leverage relative to fixed costs, the stronger revenue growth, there is that means. And of course, the policy reaction to the variant shutting down or trying to solve or having policies for zero COVID in Asia, extended supply chains. There was already a strong economic case to restructure supply chains, rebuild the capital stock in the US. We think that that case is so compelling that we're going to have a very robust CapEx year. And that's going to be a big plus for the corporate sector, not for all companies, obviously, but for those reflationary sectors in particular. We think it's going to be quite a good year for that. So that's enough on that. Looking forward to this week. We do get the minutes of the FOMC meeting coming out on Wednesday, and we think it could be very interesting just again around this discussion of sequencing. Is the Fed willing to start shrinking their balance sheet simultaneous with liftoff? Note that two-year notes did push higher through the month of December and have pushed slightly through the Fed summary of economic projections of 3 rate hikes in 2017 or 2022, excuse me, I just went back in time 5 years. So we have this question of, will they start contracting the balance sheet right away? If they do that, it would steepen out the yield curve. We stumbled across a paper the Kansas City Fed wrote about that back in October. That was quite interesting. So we do think there's going to be an increasing amount of discussion about this. We should see it in the minutes. Bullard is scheduled to speak. And we doubt Mary Daly would talk much about this. She seems more like a traditional Keynesian macroeconomist, but we would look for additional Fed speakers to populate the calendar and talk about this sequencing and potential of shrinking the balance sheet sooner rather than later. And then, of course, next week we get the labor market data. We would note that the JOLTS report comes much earlier than it typically would this month. So we may be able to get out a very interesting payroll preview before the report on Friday, and we'll try and do that because we'll get that November JOLTS data. We'll know a lot about worker reallocation and turnover. We would presume that the proliferation of the Omicron variant would hold back participation, so we probably won't see much progress on that front. We will be able to tell you a little bit more about labor market slack, which has already been incredibly tight. That implies strong wage gains, although there's been issues with seasonal adjustment factors on that average hourly earnings series around to the end of the year in the past. So there's always a possibility of a surprise, but the trend is for much stronger wage growth. And with jobless claims and continuing claims in particular back at late 2019, or February of 2020 levels, you'd have to think we're going to get another very strong report, notwithstanding the effect of the latest wave of the variant on that. So that's it for me this week. The market's obviously starting off with a pretty good tone. S&Ps are up about 15 handles as I'm recording this. You'd expect going into earnings and into that employment report, we'll have this continued push-pull between worrying about tighter monetary policy less liquidity. The Treasury is going to start rebuilding their balances at the Fed, the Treasury general account. So there will be some diminished liquidity, and that will pressure markets at times. By the same token, though, the macro outlook for us looks quite good. So that's it for me this week. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thanks.